Hello and welcome to Investing Basics. My name is Maurice and I'm a financial analyst in London. In this class we're going to set up a business together, a coffee stand. We'll start by attracting investors and launching the business. We'll then move on to examining the three most important financial statements and how to use them in analysing whether a business is investable or not. Finally, we'll look into how we can cash in, both from starting a business and also from investing in them. Let's get started. So let's say we start off with $500 of our own saving. Our modelling suggests that we're going to need a bit more. We're going to pay for a coffee stand, coffee mugs, ingredients, staff, marketing, etc. So we go to the bank. The bank is willing to lend us $250, which is great. But it's only willing to lend us those $250 on the condition that we pay 10% interest a year for a term of 5 years. So every year we'll pay the bank $25, which is 10% interest. So $25 every year for 5 years, and then after 5 we'll pay back $250, the principal amount. Why debt? Why have we chosen debt to finance the business? Well, this way we keep more stock for ourselves, so we stand to take all of the future profits since we're the only investor in the business so far. We really believe in this business. We think it can go far, so we want to keep as much stock and shares as possible so that we can take all of the profits going forward. Secondly, it's cheaper than equity due to debt being a lower risk investment, i.e. in this case the bank knows they're going to get a 10% interest repayment every year for 5 years, then after 5 years they'll get $250. But equity offers uncertain returns, and the value of the investment can go up or down, whereas the debt is locked in and is essentially capped. We'll explore this in a bit more detail later on, so don't worry too much now, but just remember debt is a lower risk investment than equity. Finally, debt is tax deductible, so as you'll see in a bit, we pay interest out of pre-tax profit, which means our post-tax profit is larger. So the pre-tax profit, we pay interest and then we get taxed, leaving a larger post-tax profit for us. So now we've got a total of $750. However, this is still not enough to start the business. Well, another capital raising technique is to give away equity. So we'll start our business with 1,000 shares. This is just a number, a made up number. Don't worry too much about it. We'll then give away half for $500 to this investor. So now I own 50% of the business and the investor owns 50%. This is a bit like what you see on Dragon's Den or Shark Tank, where investors give away a percentage of their business for a cash investment. We've given away 500 of our 1,000 shares we owned for $500. So that values the shares at $1 a share. So each share is worth $1. Why have we chosen to give away equity this time? Why have we not given away more debt? Why haven't we taken on more debt from a bank? Simply because taking on more debt is dangerous. Firstly, banks will now charge a higher rate than 10% because they know we have existing debt with another bank for $250. So for a second bank to come in, they'll know that is less likely for them to get their money back because we already have loan obligations to deal with to the first bank. So then they'll ask for a higher rate to compensate for the higher risk that they're taking on, the risk that they may not get their money back. And then, even if we take on a loan at a higher rate, we now have 2 banks to pay back interest and principal, and we haven't even earned $1 from our business yet. So essentially, it's very, very risky until we start generating cash flow. So we should avoid taking on more debt. So now we've determined that we have enough capital to start the business, great. We can now look at the business and imagine it sort of like a set of scales. On one side we have our assets, and on the other side we have our liabilities and our owner's equity, also known as shareholder equity. Under our assets we currently have $1,250 worth of cash, and on the other side we have what the two methods by which we raise the cash. We raise it from the bank. The more common representation of that scale is this. This table is called a balance sheet, and it shows a snapshot of the financial position of a business at a particular point in time. And, as we saw in the previous slide, each side should balance, where our assets should equal our liabilities plus owner's equity. This complicated balance sheet is akin to one that you might find in a company's annual report. But for our coffee stand, let's simplify it down to its raw components. There we go. This is the template that we'll be using moving forward through the lesson, and hopefully you can determine where each entry came from, where the $1,250, the $250, and the $1,000 came from. I'll give you a second to think about that. So the $1,250 is the cash, obviously, that we raised, and we raised that through $250 from the banks and $1,000 from us and the equity investor. So we have $1,000 of equity in the business, $250 of debt in the business, and $1,250 of cash. Okay, fantastic. Now to buy some stuff for the company to actually start it. First of all, for a coffee stand business, the first thing we'll need is a coffee stand, and that's going to cost us about $500. This is a fixed asset, right? It's a long-term piece of equipment that will use in operation to generate profit. Then we'll need some inventory. We'll need cups, water, milk, saucers, spoons, etc. This is going to cost us about $450. So now what does our balance sheet look like? Here's our new balance sheet, and the first thing you should notice here is that our cash balance has decreased. It's decreased from $1,250 to $300. This is due to the $750 we've just spent. $500 of that expenditure was on a fixed asset. That fixed asset was the coffee stand. There you go. And then $450 was on the inventory. This is the stuff that we're going to need to make and serve the coffee. However, look at the total assets figure. It remains unchanged. This is because the value of the assets hasn't changed. We haven't generated any profit yet. We've just spent money on getting the business prepared and ready to start making coffee. On the bottom half, everything's unchanged. The balance sheet's unchanged in that bottom half. We still owe the bank $250, and the equity value remains the same. So now we've got everything to start our business. Let's see how it did over our first year in charge. Don't be overwhelmed by this slide. I know there's a lot of information on show, but we'll go through each line item in detail. So to look at a business's performance over a period, we look at the income statement, which is what's in front of you right now. Remember, the balance sheet is a snapshot of the company at a particular moment in time. The income statement, however, shows the profit and loss of a company over a period of time, in this case, a year. Here's our income statement over the first year. We can see that we sold 500 cups of coffee at $2 a cup. This gave us a total revenue of $1,000. However, we spent $450 on inventory supplies. In this case, it's called cost of goods sold. We also have a new line item here called depreciation. What's depreciation? Well, this is a line item on the income statement that indicates how much of the value of an asset has been used up. In this case, we're depreciating the value of the coffee stand itself. Let's assume that it has a useful lifetime of 10 years before we replace it. We can then linearly depreciate the cost of the asset across the 10 years, using a depreciation cost of 50 a year, because it started off being worth $500, divided by 10, that's a cost of $50 a year. 500 divided by 10 is 50. The asset starts off being worth 500 when we buy it. After a year it's 450, after 2 years it's 400, all the way to 0 in year 10 when we have to replace it. Now the purpose of depreciation is to match revenue generated by that asset, in this case the stand, to the expense incurred from that asset. We can use the stand for 10 years, so it's only fair to spread that value across 10 years. If not, we'd have a year with a massive loss where we bought the asset for $500, followed by years of high profitability. Extremely variable financial results are not a desirable trait for a company. Just a side note as well, there are many ways to depreciate. The way we're doing it is called the straight line method, where we depreciate it by the same cost each year, but some depreciate it by curve, where depreciation starts off fast and slows down towards the end, or also by the product. So example would be by the cups of coffee sold, they might depreciate it by that. After depreciation we have 2 line items: payroll expenses, for paying for the staff who work for the stand, and we have SG&A, sales, general and administration. This is, for example, paying the accountant to prepare our statements, or lawyers if we get in a legal dispute. This leaves us with a EBIT, that is earnings before interest and tax, of $100. This is our pre-tax profit. Then we pay our interest on the debt. Do you remember? 10% of $250, that's $25. That leaves us with EBT, earnings before tax, of $75. Assuming we're in a tax rate where it's 20% of corporate profits, tax would be $15 for us. That leaves us with a first year net income of $60. So in the first year of operation we made a $60 overall profit that year. That's great, that's really good. So really, before we can take a look at the balance sheet at the end of the year and compare it to the start of the year, we need to look at the cash flow statement, which is in front of you now, to see how our cash balance changed. The cash flow statement summarizes the amount of cash and cash equivalents moving into and out of the company. It's broken down into 3 sections. The first section is cash flow from operations or operating. In this case, this is all the cash generated from selling coffee. As we saw, that was $60 of net income, and we also add back depreciation. Why do we add back depreciation? Well, because it's a non-cash expense. Think of it this way: we buy the stand for $500, we depreciate it each year by $50 for 10 years until it's worth nothing. But each year we're not paying $50, it's just a $50 loss in the value of the stand. Instead, the only cash expense we incurred was the $500 we paid for the stand at the start of the year. This comes under our CapEx. And the CapEx spend is in the cash flow from investing section. As we invest in a coffee stand, it is an investing activity to grow the business. Finally, we have cash flow from financing. This is all the cash involved in transactions regarding debt and equity. In our case, that's 2 positive entries of $250 from the bank and $1,000 of equity from ourselves and the investor. So as you can see, our end cash balance after year 1 was $860. Let's take that value and put it into our updated balance sheet. So here's our updated balance sheet from 1 year in business. As you can see in our assets section, we have $860 in cash. That value's come from our cash flow statement just seen previously. Then we have $500 worth from our coffee stand, but remember that's been depreciated by $50. It's worth $50 than 1 year ago when we bought it. That leaves a total assets figure of 1,310. That's up from 1,250 a year ago. Then in liabilities and assets, we still have a $250 debt to the bank, so that remains the same. Therefore, the shareholder equity must rise in value to ensure the two halves of the balance sheet balance. This means that shareholder equity is now worth $1,060, $60 more than when we began the business. And if we look at how that affects the share price, we remember there's $1,060 divided by 1,000 shares in issue gives us a total share price of 1.06, so $1.06. That's up from $1 a share to begin with. For us, what does that mean? Well, we own 50% of the company, that's 500 shares. Our initial investment was worth $500. That means our investment now is worth $530, up from $500 at the start. That's a 6% return in 1 year, pretty good for a startup business. So now let's fast forward again to 3 years later and see how our company is doing. So here's the income statement after 3 years in charge. The first year is left in there for comparison, where we had a net income, of course, of $60. In year 2, we made the decision to buy a second stand for $500 in a different location because of the great year we had in year 1. However, as you can see, revenue disappointed. It didn't double, which you'd hope for with a second stand. In fact, we sold roughly 400 cups per stand in comparison to 500 per stand in the year before. The cups remained at a price point of $2 a cup, so the total revenue was $1,600. As you can see, expenses attributed to COGS, depreciation, payroll, SG&A all increased due to the second stand. This left us with a rather concerning EBIT figure, earnings before interest and tax, of negative $150, and after our regular $25 payment to the bank, 10% interest on $250, we were left with a earnings before tax figure of negative $175. Due to the fact we made no taxable profit, we didn't have to pay tax this year, which is a small upside in what was altogether a terrible year for the business, with a negative net income of negative $175. However, in year 3 we made some improvements to the business. First of all, we began to use more expensive beans from a different provider. We upped the price of the cup of coffee to $3 to reflect this. And we also made some changes to the back office to streamline the business. For example, this could be using one central finance department instead of one for each stand, etc. Therefore, year 3 was a much better year for the business. We sold 1,250 cups of coffee at $3 this time, which gave us a total revenue of $3,750. This is a record for the business, so a great year in terms of revenue. However, also COGS increased slightly due to the usage of more expensive beans. However, most of the other expenses, if you have a look at them, either remain the same or decrease due to the changes we made to the business. EBIT for the year, earnings before interest and tax, was $1,950. Then we made our regular payment to the bank, and we were taxed at 20% corporate tax rate. After those two deductions, our net income was $1,540. That's a great year for the business and much better than the year before. Taking the same approach as in year 1, let's now look at the cash flow statement. As we know, in years 2 and 3, we made negative 175 and positive 1,540 in net income respectively. In the second year, depreciation doubled to $100. This is because we bought the second stand. So now we add back $100 of depreciation a year, $50 per stand. Remember, we are adding back depreciation because it is a non-cash expense. If I own a BMW and it begins to lose value as I drive it around, I don't actually pay for the loss in value. That loss is incurred when I decide to sell the car or when this car becomes no longer drivable. Depreciation is used to smooth that loss over the useful lifetime of the equipment to ensure a less lumpy and unpredictable earnings report. CapEx was negative $500 as we bought the second stand, but note, in year 3 it is nil because we didn't make any further purchases. There was no more equity issued or debt taken on over years 2 and 3, so those figures remain nil. Therefore, as you can see, we have a reduced cash balance of $285 in year 2 and compared to a huge cash balance of $1,925 in year 3. Let's see how those figures fed through into the balance sheet and ultimately the company valuation. Did we lose money or make money on our investment over the 3 years? Here's our balance sheets comparing all 3 years of the business. So the headline figures are really, you can see that shareholder equity increased in value, whereby you can derive that the price per share increased from $1 a share to $2.43 per share. That means for us, having owned 500 shares initially worth $500, we made a 143% return on the initial $500. Our investment is now worth $1,215. As you can see though, this wasn't an easy ride. It wasn't a guaranteed money-making scheme. The share price varied quite wildly over the 3 years, sinking to a low in year 2 of 89 cents. Let's just examine some of the changes in the makeup of the balance sheet over time. In year 0, when we started the business, we had the cash raised from the bank and the investors and ourselves, but no assets. That's pretty simple. To recap year 1, we had a closing balance from the cash flow statement of $860. We bought a stand for $500, but it depreciated over that year by $50. In liabilities and equity, debt remained the same, $250 owed to the bank. And we had an increase in shareholder value by $60 to ensure that both sides of the balance sheet balanced, meaning the value of one share was then $1.06. The following years we use much the same methodology, so no point going through as painstakingly, but a point to note is that the accumulated depreciation in year 2 is $150. Why is that? Well, because we have had stand 1, which we bought from the very beginning, operating for 2 years, so it's been depreciated for 2 years. $50 a year times 2 years is $100. And then we bought a stand at the start of the second year that ran for a year and accumulated 1 year's of depreciation. That's $50. Add them together, $100 from the stand 1, $50 from stand 2, and you get $150 accumulated depreciation. Taking all that into account, our total assets after year 2 was $1,135, and to get the balance sheet to balance, we had to decrease the value of shareholder equity to $885, giving us, as you can see at the bottom, a value of 89 cents per share. A very poor year for the business. Year 3, as we know, was much better due to the changes we made to improve the business. This caused shareholder equity to increase to $2,425, about $2.43 per share. I would encourage you, really, to work through year 3 in your own time to make sure you understand where each line item came from. It's pretty simple. You can see it, use the previous income statement and cash flow statement to help you out, but hopefully you can be able to do that. Work through that in your own time, please. So, after 3 years, are we investable? If Warren Buffett, the world's most famous investor seen here, took a look at our business, would he deem it a good business or a bad business? There's also the decision to make on whether he wants to invest in equity, like ourselves and the investor, or in debt, like the bank who gave us a loan. Well, what most investment analysts will do when assessing a company is extract data from the financial statements, the income statement, balance sheet, and cash flow statements, and compute various ratios. Let's ignore the table with these ratios for now and just focus on the post-it notes on the right-hand side. These address the important figures for us as the equity investor in the business. The first one shows the earnings per share growth. This is a measurement of the company's profitability. It is calculated by taking the net income, taken from the income statement, and dividing it by the number of shares outstanding. In our case, it was 1,000. If a company has a high earnings per share, it means it has more money available to either reinvest in the business, which means hopefully future profits for us, or distribute to shareholders in the form of dividend payments. In either scenario, the investors win, so that's really good that it's increased for us. A 406% increase is a huge win for us and very attractive to investors looking to invest. In terms of money put into the business, $1,000 of equity was initially invested in the business by us and the investor, and as of year 3, it's earning over 150% of what we put into the company. That's another great, really high number and great for us again. Finally, and arguably the most important figure for us, is what is our investment worth now? As the share price is now $2.43 and we own 500 shares in the company, our investment is now worth $1,215, a 143% return. So as an equity investor in the company, we did very, very well. So Mr. Buffett may be encouraged to invest in equity. But we also have debt investors, and he wants to see how our only debt investor, the bank, did before he invested. So let's take a look. So comparing the equity investor to the bank, the investor put up an upfront investment of $500 and the bank put up $250. After the 3 years, the investor made an 143% return on his investment, whereas the bank only made 10% through the interest payments we were paying him each year. Why did the equity investor earn so much more than the bank? The answer is they took on more risk. If the business failed, the lender is entitled to the first $250 that comes from liquidating the company. The person who owns the stock is wiped out because they agree to be after the lender. Since it's an inherently safer investment, debt offers a lower rate of return. You know you'll get paid 10% per year and then $250 at the end of the loan, whereas equity is unpredictable. There's the point about the business failing, and remember at the start, neither knew whether the business would succeed. The bank was less willing to take on as much risk as the equity investor. However, as I said, debt has fixed and predictable payments, so the return is capped. The risk to him is the creditworthiness of the company, the ability to pay back the debt. At the start, the credit risk of this company was very high, as it was a startup with no earnings and the direction of the business was unknown. For the shareholder, the risk was really the profitability of the company, the ability of the company to turn a profit. He has no guarantee of earnings, he only has claim to the residual value after debt has been collected. In this case, the company was profitable, so it was able to service its debt, and therefore the investor had claim to the remaining profits. He is compensated for taking on more risk with the possibility of uncapped returns, unlike the bank, which is capped to 10%. So the question is now, why was the bank only willing to take on 10% return when the equity got so much more? Why not 20% or 25%? We know that debt is safer than equity, so will naturally return less, but why did the bank choose 10%? So starting from the very beginning, when you go to the bank and you open up an account, you'll find that each kind of deposit account comes with a different interest rate, depending on the bank and the account. Essentially, a bank will then take the funds deposited and lend them out at a rate higher than the interest owed to you. In this case, they owe you 1%, so they're going to try and lend it out at a rate greater than 1%. It will then receive the returns from the money it's lent out and pay you your owed interest and take the remainder as a profit. The remainder is called a spread, the difference between the average yield that a financial institution receives from loans and the average rate it pays on deposits. So in this case, let's say the bank offers a 1% interest rate to depositors. The lowest risk investment the bank can make is to loan money to the government, because the government is extremely unlikely to go bankrupt and default on the loan. It can do this by buying government bonds. So in this case, you give the government $250 and you get a security, a bond, that pays 1.5 interest per annum, and then you get your $250 back on expiry. This means that the bank can then pay its investors the 1% promised, and it can also make a 0.5% spread. This government bond really provides the floor, because if you can lend money to the government at 1.5%, you're going to want to earn meaningfully more if you lend to a startup coffee stand business, because it's much higher risk. So the bank chooses to lend at 10%, making a 9% spread over customers' accounts and an 8.5% spread over what it would have made if it went with the safest investment, the government bond. Why only 10%? Why didn't it charge 30, 40, 50%? Well, because on the flip side, consumers and businesses seek the lowest rate possible. This bank was charging the lowest of all the alternatives available. If they went too high, they wouldn't earn any money at all. Competition is driving the rates down. So now that we understand all those concepts, let's go back and look at these ratios in a little bit more detail. As an equity investor, you're interested in those in the yellow-orange box. These are called profitability ratios and relate to how likely the company is to turn a profit and how big that profit might be. If you are a debt investor, the ratios you're interested in are in the green box. These are called solvency ratios and relate to how solvent the company is or how able it is to pay back its debts. Just looking at a couple of the equity ratios and a couple of debt ratios. In equity, you can see the share price has increased. That's obviously excellent. The gross margin has increased. net profit margin has increased, return on assets has increased, so all good signs for an equity investor. In the debt sphere, the debt ratios have shown improvements as well, so it's attractive for a debt investor. Here you can see the interest coverage ratio, which is very important. This is how able a company is to pay its interest payments. It takes its EBIT, earnings before interest and tax, and divides it by the interest expense, which in our case was $25. And this shows how many times over our earnings could cover the interest expense. So we started being able to earn 4 times more than the interest expense, and by year 3 we're earning 78 times more, which is incredible. So we're extremely able to pay back our debt. Also, as you can see, the ratio of debt to total assets decreased, so less of the company is made up with debt. Another coverage ratio here that's important is the cash flow coverage ratio. That shows how much of our operating cash flow can cover our debt, and you can see here that our CFO can cover 6.6 times the total debt. So our total debt was $250, we can cover 6.6 times that. That's very, very attractive. It means we're extremely unlikely to default on the debt, so a debt investor would be very encouraged by these figures. So we've looked at external investors and we've seen that we're an extremely attractive prospect. But let's look at our position for a moment. We started this coffee stand business. The point of this business was to make money. The business is doing exceptionally well after 3 years. Yet as an equity investor, we've made nothing. Our stake in the business has grown in value by 143%, but we don't actually have any cash in hand to spend. You might want a nice watch or a nice car or phone, for example, but we have no cash in hand from the business. What are your choices? What can you do to take cash out of the business? So far, while we've been running our business, what we've done is taken all the cash that we've generated and reinvested it in the business. The good thing is we've taken all that money earned and bought a new stand, new ingredients, hired new staff, and ultimately grown the value of the business exceptionally fast. An alternative could include now, instead of growing the business so fast going forwards, we could take some of the profits and pay dividends to equity investors, which includes ourselves and the equity investor. The good news is that we get money along the way, we get cash in hand along the way, keeping the same amount of ownership in the company. The bad news is, as mentioned, money is taken out of the business, and therefore the business has less to invest and may not grow as quickly. Another way of receiving cash would be to sell the business altogether. That's great, we'll get a huge lump sum in exchange for our stake in the business. However, the problem with this is that we lose our stake in the business completely. So we can no longer participate in business decisions going forward and the direction of the company. And we really believe in this business and we want to remain a part of this future, so I don't think this is an option for us. Instead of selling 100%, the alternatives could be selling a piece of our stake. We can do this privately. I can find an investor, like we did at the start of the journey, and sell him a piece of our stake. This way, we can choose who we sell it to. It can be someone we trust and who is likely to back us up in our decisions and allow us to steer the company in the way we want to. However, a potential issue may be that they don't want to take the total amount we're offering or are unwilling to pay the price we're demanding. A second way is to go public. To do this, we'd need an IPO, an initial public offering. And that's the process of offering shares of a private company to the public for the first time. It'll get listed on an exchange, for example like the FTSE or the New York Stock Exchange. The good thing about this is that you have large access to cash since the public audience is huge. You increase the legitimacy of the business by listing, as there are some really stringent checks that you have to go through before you can list. And the stock is now very liquid and easily tradable, so you can easily sell more stocks if you want, or buy back shares if you choose to. The downsides include a great cost, as you will need to the help of investment banks to help with reporting, regulation, marketing, etc. You now have no control over who owns the stock, unlike with a private placement. And finally, you have to appoint a board of directors who have a duty to ensure that the shareholders are treated properly, and therefore you won't have the same degree of flexibility to make wacky decisions and choose crazy, different innovative ways of selling coffee as you would if you were a private company, as you now have other constituencies that you have to think about. In this last section, let's talk about how to invest successfully. The purpose of our coffee stand example was to act as an introduction into what a company is, how they earn profits, what reports they have to issue, what type of investments you can make. These are the sort of things that you need to be thinking about when you invest your own money, whether it's a coffee stand or if it's Tesla. What follows in this section is some general advice that you should apply on top of your learnings that will help you invest successfully. So before you actually start investing, you need to make sure you fill in the criteria that I'm going to outline below. Firstly, you need to be financially secure. You have to be comfortable that you have enough money in the bank, that you don't need it in a rainy day or in day-to-day life. Number two, you have to recognize that an investment will go up and down. They're influenced by events going on in the world that you have no control over. You need to accept that your investment can go meaningfully down and not get spooked so that you can collect the upside when it eventually comes. Number three, don't just buy a stock because you like the name of a company like Monica in Friends. You should do your own research and investments, or if not, use money managers, which we'll touch on next. Fourthly, you need to be willing to go a different direction to consensus. If you don't believe that this is important, watch or read The Big Short by Michael Lewis, and then you'll understand. Number 5 is understand compound interest. This is very important. And the point I'm really trying to make is that it's not about the market timing, it's about the time in the market. If you invest $1,000 at 20 years old and make a 5% return every year until you are 60, you'll end up with about $7,000 in the bank because the interest is compounded. In other words, you're earning interest on the interest earned in the year before. After the first year, a 5% return will give you $1,050, and then you earn a further 5% return on $1,050 in the second year, and it keeps going and going and going. To show you what a difference time makes on compound interest, if you started to invest at a 5% return a year, but only started at 40 years old, by 60 years old, you would have only $2,700 in comparison to $7,000 if you had started at 20. The most powerful asset you have is time. Finally, read and learn. By doing this course, you're already doing the right thing. Continue to build on what you've learned. Maybe try another one of our courses, or have a look on YouTube. There's so many great resources to make use of online. Make sure you use them. So if you're investing in individual stocks and bonds like the chap on the left hand side here, you want to follow the points outlined below. Make sure you understand the company's business model. For example, Coca-Cola. They sell cola, their profit depends on how much soda they sell over a year. That's a very understandable business model. Make sure you understand the company's business model before you invest. You want to invest at a reasonable price, and then set yourself a target price at which point you'll sell out of your investment. You want a company that uses very little leverage, very little debt, so that if there's a big shock, if there's a big financial crisis, it is more likely to survive. Finally, you want a company that operates in an industry where there are high barriers to entry. You don't just want any other startup company to just come along and steal market share from your investment. That would really damage your investment. There's really two ways of investing. There's the individual stocks and bonds method, like I've just outlined, or there's the use of mutual funds. A mutual fund is a pool of money collected from many investors and run by a professional fund manager. He will choose to invest it in securities like stocks, bonds, and money market instruments, and other assets. And because he's a professional, he does this on a daily basis. He has a lot more time to research. The benefit of this is, with a limited amount of money, you can buy into a diversified portfolio managed by a professional investor. And you don't have to worry about stock selection and research, and you can spend your time on other things important to you. When investing in mutual funds, you want to find a manager with a good reputation or rating. There's over 50,000 mutual funds out there. You need to really compare different investment managers. There's loads of sites that you can look and see how good a fund manager is rated, but you need to make sure that you're with a good fund manager with a good rating. A manager with a clear and consistent investment strategy. You don't want a manager who just jumps around and jumps on bandwagons, because that could be very detrimental. You want someone who has a clear and consistent investment strategy. In the past, this has always worked best. Warren Buffett has had a clear and consistent investment strategy, investing only in value stocks. You've had other investors who have invested only in growth. They have a consistent strategy, they know their niche well, and they can guarantee, or at least it's very likely, if you invest with them, that they'll generate returns. Understand your goals. There's different types of mutual funds. There's income funds, which pay you income every year, or there's capital gain funds, where you put in an amount of money, and then when you want to, you can take it out, and hopefully it's gained in value. Also, what's your timeline? Are you 20 years old, or are you 60 years old? If you're 60 years old, you want to invest in a safe investment because you might need the money because you're going to retire. If you're 20 years old, you might invest in more risky assets such as equity. So look at your timeline and look at the risk and sort of what your goals, your individual goals and needs. And finally, I'll only touch on this, but passive versus active management. Passive management essentially tracks a benchmark. So you buy into a passive fund which will track the S&P 500 exactly. Even if it falls, it will track it, and you'll get the returns exactly off the S&P 500 over a time period of a year, say. Active management will actively try to beat that benchmark. So say over the year the S&P goes up 5%, the fund manager will try and beat the S&P and make 7%, for example. Now the difference between these two is, with passive management, you're just getting the benchmark returns, but you can get that very cheaply. Whereas active management, you're trying to beat the benchmark returns, but you're not necessarily guaranteed to beat it, and you're paying a lot more. So you want to see if you prefer to track the benchmark, if you think equities are going to go up and you're happy with a cheaper source of capital gain, or you want an active manager who will actively try and beat the benchmark and get you higher returns. So in summary, we've learned how to set up a new business and the types of investment available to us, particularly debt versus equity. We've learned about the balance sheet, income statement, and cash flow statement and how to analyze them. We've learned what successful investors look for in businesses when selecting investment, particularly looking at ratios. We've learned how to make money as a business owner or entrepreneur and the various ways of cashing out. And we've also picked up some tips for investing. Now it's time to start. Thank you for your time and for listening to this. Check out some more on our Skillshare page, and good luck!